Hello and welcome to Pitch the PM. My name is Doug Garber, and I'm here with Mark Layden, the CFO of Mammoth Energy Services, ticker TUSK. This is a small cap company, and before we begin, I do want to disclose to everyone that I do own shares in TUSK, and everyone should do their own research, and this is not investment advice. You should talk to your financial advisor, especially before investing in smaller cap companies. I've known Mark since the company's IPO over a decade ago. Mammoth Energy Services is both an oil field service company, but also has industrial assets and now has a lot of cash to deploy. With that, I'll turn it over to the current CFO, Mark Layden, and he can give you a quick background of the company and then where it's heading in the future. With that, Mark.
Thanks, Doug. Appreciate the opportunity today. I think in regards to a quick background on Mammoth, we went public in 2016 as a pure play oil field services company, largely centered in the Utica and Marcellus. Since the IPO, we expanded into the transmission and distribution business in 2017. Have done a couple of other acquisitions throughout our time to expand our asset base. As we sit here today, we've got about $150 million in cash. We've recently sold the T&D business for about $110 million. So asset-wise, we're largely oil field services again, but we began to deploy capital into the infrastructure side of the business again, and into rentals. So we're excited about the future as we look forward.
That's great. And I was actually surprised that you sold the T&D business. Can you talk to us a little bit about why you sold it and the history of that investment and how you grew it over time?
Yeah, so that investment was, early on to diversify the asset base and seek more stable earning power for the business. Oilfield services has always been cyclical, so immediately after the IPO, we wanted to stabilize our earnings potential, acquired two small entities for about $6.4 million, deployed about $20 million of capital to grow those businesses. And as many of you probably recall, 2017 was the year of the hurricane. So we caught lightning in a bottle. We're able to respond to hurricanes in Houston, through Harvey, through Florida, where Irma hit Florida, and then ultimately Irma and Maria hit Puerto Rico. So we landed two contracts in Puerto Rico, did a tremendous amount of work there. Unfortunately, spent several years trying to collect for much of that work. But all in, as you look at it, we generated about $310 million in free cash flow on that investment, not including the sale of about $110 million.
So it's over $400 million of free cash on an investment of, call it $26 million in 8 years. Is that right?
We had $26 million invested in 2017, and then we invested another $100 million in 18 as we expanded the work in Puerto Rico. So about $135 million round numbers that was invested, and then generated a little over $400 million in free cash flow on that investment.
Why exit it? Why not continue to grow? You've seen companies like Quantum, Oztech, Primoris, they've all done really well growing. It's a steady business with the utilities. Investors love the theme of, electrical infrastructure. So why get rid of it? What are you going to do with the cash?
As we looked at it, we sold the company for about 4 times tangible book, about 9 times trailing EBITDA. So we thought it was an accretive transaction, allow us to monetize our investment in those assets. And then we'll pivot that cash into areas that we think will have attractive returns. In particular, we currently like the rental business, which is fairly broad. We've had, oil field equipment rental businesses in the portfolio for quite some time. It's flown under the radar a little bit, but we've had helicopters inside of our rental portfolio for some time. And then in April, following the transaction, with the sale of the infrastructure entities, the T&D business unit. We bought 8 airplanes to add to that overall rental portfolio. That's an interesting space where we're seeing quite a bit of deal flow through our relationship with Wexford Capital at attractive returns. We're seeing IRRs of 25 to 35% on discrete investments.
Those IRRs, those are unlevered or levered IRRs?
Those are unlevered.
So the current investment you guys made in April of about, I think it was like 11.5 million for 8 planes. You're saying that's your target's kind of a mid-20s to 30% IRR unlevered?
Correct.
Great. And how much contract coverage did that investment come with that you made there?
Yeah, so that's a good question. So those aircraft came with underlying leases that range from about 6 months up to a year and a half to 2 years. So as we look at that, we've got an opportunity, we think, based on entry point, to increase the returns that we've currently forecast on those planes.
Okay, so there's some residual value and market there. And I've seen some other large investments come across kind of my LinkedIn profile of other people making big jumps into the commercial airline space. So thank you for that color. I think that actually having that vision there. Talk to me more about the pipeline there. You're talking about how deep is it? How many deals? What else are you looking at besides kind of airplanes?
It's a fairly broad space. So, if you look at Wexford's history, they've been in the airline sector for decades. They have a fairly robust deal flow. So, what we see is deal flow on both aircraft as well as heavy aircraft engines and ancillary equipment. So I think that just speaks to the quality of the relationship with Wexford and the deal flow we get from them relative to that relationship.
It's an interesting place in the capital markets. It's kind of a private equity company in a public shell. And since it's in this kind of void, you kind of get it without the fees attached. Is kind of how I described it to some other people when I talk about it, at least. But I'm not sure everyone has this view of how diverse this industrial pipeline is from deal sourcing to incubation to growth to exit that you've kind of done here in T&D over the last few years. Can we talk about the energy assets? When you went public, you're mostly an oil service company. And, last year was, I think, you're focused in the Northeast supporting Gulfport, right? And last year was one of the worst years ever for natural gas, 221 Henry Hub, and even worse in the Northeast, right? Probably $50, $70 diffs up there. And how do you view the energy market? How do you view the energy market now and your place in it? And let's talk about your main service lines, the sand market and the pressure pumping market. Actually, let's just do the pressure pumping market because sand's a whole nother macro.
Yeah, on the pressure pumping side, we've always had a historical presence in the Utica and Marcellus. As you touched on, a large part of that came through the relationship with Gulfport. Gulfport was founded by Wexford many years ago. As Gulfport entered the Utica, Wexford and Gulfport co-invested to form our frac company. And our frac company kind of propped itself up based on that relationship with Gulfport. Since that time, expanded that customer base, have had a decent presence in the Northeast. I think as you look at our equipment, we've got 6 spreads in total, the majority of which are in the Northeast. Over the last couple of years, the majority of the equipment that has worked has been in the Northeast. So long term, I think you look at our asset base and conclude that we lack overall scale. The larger frac companies have 20 spreads or thereabout. So it's up to us to maintain utilization We can generate free cash flow at about 1.5 spreads of utilization if we can keep 1.5 spreads busy. Obviously, last year, as you touched on, was difficult. Utilization was less than 1 spread for most of the year. As we always done historically, what you have to do is aggressively cut cost. When utilization falls. So we did that last year, and we'll continue to do that in future cycles.
And you guys have disclosed, I think, a second spread going to work in March on your last conference call. Do I have that right?
That's correct. We discussed in the last call ramping up to 2 spreads.
You guys have also invested to upgrade your engines to dual fuel to lower the cost for the operators, use some field gas. Can you remind me how much you invested and why did you invested essentially counter-cyclically? Why put money into new engines at this point?
Yeah, so we did invest counter-cyclically to upgrade one of the fleets to Tier 4 dual fuel. We've got about two fleets of Tier 2 dual fuel, but we invested counter-cyclically to begin upgrading a third fleet to Tier 4 dual fuel. Those cost about $1 million, round numbers, per pump by the time you put in a new engine. Some need new transmissions or power ends. But I think we converted right at 8 or 9 last year. So you're at $8 to $9 million in relation to conversion to Tier 4 pumps for that fleet.
And you were able to make that investment even when you were paying your interest paid in kind to Wexford. So they kind of propped you up there, helped you out before you got the Puerto Rico money and gave you kind of that ability to do that. Is that how I should think about that? Because I was surprised that you were making that investment in such a tight period for yourselves.
Yeah, so we wanted to be prepared to the extent that natural gas recover. I think as you look at natural gas, it's obviously priced stronger today. I think as most people look at the commodity, I think they're pretty bullish going into 26. So some of that optimism has been pushed to the right a little bit in regards to natural gas, but I think the mandate is clear from the larger E&P companies that it's clearly much cheaper for them to burn field gas and better from an emissions standpoint. So to keep the equipment competitive, at the time we felt that it was a good counter-cyclical move to invest in the upgrade of one of the fleets.
Kind of like you invest $10-12 million to stay relevant. Otherwise, you kind of have to shut down and you lose the people and everything. And if you invest that $10-12 million, you get back to work and you have the option value of generating 20-30 million of EBITDA again one day and get in a 2, 3, 4 multiple on that. So is the math, hey, I'm going to invest 10 million and now I have the option of potentially exiting at 60 million? Is that too simplistic for someone who runs a business, or is that a fair way to think about it?
It's a fair way, to think about it at a high level. I think as you look at it, it's an investment in the business to maintain relevancy, and to the extent that results in a higher multiple on a potential trade at some point, perhaps. The OFS business has always been highly cyclical. So as you're aware, on the buy side, it's tough in OFS to make any long-term forecast.
We saw EOG, their activity was growing in the Utica by themselves was up 50% to 2 rigs. They were talking about that earlier in the year. And then they just made an even bigger investment with Encino in the Utica, really saying, hey, this is going to be a big play here. This is their third stool, essentially, right? Third leg of the stool, not third stool. But what are your thoughts around EOG and that transaction and what it means for the Utica, for TUSK?
For EOG, I think it's a great deal for them. For TUSK, that's a company we've worked for historically. So certainly anytime that one of our customers makes an acquisition of that size, that's exciting for us.
EOG was a customer historically. What about Encino?
Encino, we've done, I think, just a little bit of work historically, but EOG we've worked for historically with our frac company.
And if I remember correctly, EOG is usually they just want the horsepower. They provide they kind of do everything else themselves. So they're kind of just they want the bid from spring the horsepower, right? They don't necessarily need all the extras that the big boys provide. If I remember correctly.
Yeah, that's been our experience, that it's been people and horsepower, and they're not alone in that. There are a lot of the E&P companies that buy services a la carte and source materials on their own.
And then there's also this kind of in the Northeast in the gas market. Obviously, there's a lot of talk that the U.S. is at, call it 106 BCF per day or so, maybe 108, and that could go to 125, 130 when you add in LNG demand, when you add in reshoring, when you add in AI capacity, but AI demand. But things are trapped in the Northeast. You need the pipelines; they take years. What's the opportunity in the Northeast for, I mean, maybe data centers or just for the demand growth in the Northeast, specifically, not the global US. It has to be somewhat regional, I think.
Yeah, from our perspective, it looks like there's some potential for data centers in the Northeast to utilize some of that trapped gas. So we hear a number of those conversations. I think the takeaway from our perspective is that you're seeing some consolidation, inside of the Utica, and it looks like there's a runway for demand for gas. Need some help more than likely with data centers and other ancillary uses to use that trapped gas. But I think we're pretty constructive on the commodity, particularly in 26.
It's amazing, the whole gas bullishness. Everyone was all bullish over the winter, and now it's pushed into 26 already. We're here in June. Storage is filling up, I guess. What about wet gas? I know there's different windows in the Utica and even the Marcellus. How important is wet gas in this dynamic for the demand for your services?
No, it's a good question. We're not seeing a ton of impact right now. Most of the operators in the Northeast we've seen have fairly consistent programs for this year. It would appear, as a number of them have decent hedge positions for 25. So not seeing a big impact associated with wet gas in the Northeast.
The sand business. You guys, you and everyone, a lot of other people got into the sand business. The Northern White sand, and most of that sand has been replaced by local, regional, cheaper sands in most of the plays. Not necessarily in Canada. They still import, I think, 2/3 of their gas from the Northern White into the Western basins there, and the Marcellus still imports. But most of the white sand obviously has been backed out and shut down. Some people still use it. Can you talk about the outlook, or what are your plans for your sand mines at this point?
Yeah, absolutely. So if you look at our sand mines, we have one on the CN that is logistically advantaged into Western Canada and into the Utica and Marcellus, and then one on the UP that gets to the DJ and Permian. So to your point, in regards to local sand, the UP mine is challenged right now. Many of the operators in the DJ are 90 to 100% local sand. So that's a tough market on the UP. Western Canada, however, I think there's a lot of optimism across the sand space. So it creates some unique opportunities for us. We've sold quite a bit of sand into Western Canada for the last several years. Investment opportunities kind of center around transloads. That there may be some unique opportunities on that aspect. But the Northern White business for sand is, it's a tough business right now, given the presence of local sands in most of the U.S.
How do the transloads, potential investments, how do those compete for capital from your perspective versus things like, the rental airplane business, where you're talking about 25, 30% unlevered IRRs? I mean,
Yeah, that's where the difficulty becomes for them to compete for capital. We very much view capital allocation like a private equity shop. They each of the entities has to compete for capital. So on a sand investment, it's pretty tough for them to compete today at 25 to 30% IRRs for some of the other businesses. That being said, it makes the teams compete for that capital and identify the best opportunities. So from our perspective, that competition for capital becomes a good thing. We run a number of different businesses, and each of them are fully aware that they've got to compete for capital.
Talking to one of the other players in the sand business going into Canada, they were saying that business has kind of grown 20% historically as these new LNG terminals have come online. And I'm curious, what is your share in that business, and have you seen growth in that business?
We've seen steady to slight growth. So for us, since we've not invested in a transload, we're more inclined on the spot market to sell sand into Western Canada. That is one thing that may help them compete for capital is if you pair a transload investment with a longer term contract, you may get to a zip code that's competitive with some of our other businesses. But we've seen fairly steady demand out of Western Canada for the last several years.
And how do I think about that business? Is it, $15 a ton production costs, 2025 sales price, or what's the current
Yeah. So
market?
yeah, good question. So right now you're kind of say 23 ish, for 40/70. Some of the other grades are obviously gonna be less. It's a manufacturing business. So as you look at it, the more we can sell, the more we can drive our cost per ton down, which is obviously historically benefited the business when we've had some longer term contracts to really get the efficiency out of that business. Both of the mines are fairly low on the cost curve in regards to northern white mines. So it's really taking advantage of opportunities for us to get what we can get out of those businesses, try to maintain a rail car fleet that in a sand business, can become a fixed cost, to keep the rail cars moving out of storage and then drive as much as we can through the plants to drive the cost per ton down.
Do you currently have excess rail cars that are, sitting idle that you're paying that roll off, like extra leases that you're paying?
Yeah, I don't think we're any different than a number of our peers. As demand for sand has come down a little, that's resulted in some excess rail cars, which you see in the fleets and in rail car pricing right now. The price for rail cars is down compared to what we saw a few years ago.
So I guess from a financial impact, is there more to roll off that you could return that would help your financials, or is it just not material at this point to really help that business?
It certainly all makes a difference. So as rail cars roll off, then we'll likely return those cars unless we see strengthening demand. And that's a call that we'll have to make as those cars roll off as to whether or not we extend those leases at lower rates for short periods of time.
How much of your business sells into Canada versus what's left in the US to sell into the Northeast, the DJ, or
I'd say right now we're heavily concentrated towards Canada sales.
directional drilling? Can you talk a little bit about that business? I did read in your 10K that you're still doing a little bit of work for, I think, some of the Wexford E&Ps. That's lumped in your other segment. How big is that segment, and how do you compete there?
Yeah, so that's a business that's largely relationship driven. They've got the capability of running 3 to 4 jobs at one time. So for us, it gives us the ability for relatively low ongoing investment to keep that business going. It's not a business that we have scale in, but it's also a business where tools are fairly easy to rent and to obtain. We're fortunate that we've got some pretty good motor shop personnel that have been with us for a number of years. But that's a business that has struggled. I'd say the last several quarters, seen some bright spots, but we're hopeful that they can increase their utilization and generate positive cash flow out of that business. But in the grand scheme of things, that's a fairly small investment that we've got inside of the portfolio.
And the accommodations business, is that how big is that? Is that material at all? And what's the update there? I know some of the peers have had tough times over in Canada.
Yeah, it's interesting. So if you go back to shortly after the IPO, the accommodations business was actually its own segment, so split out and had a little more visibility than what it's got today. That's a business that's done well. That business was formed by Wexford in about 2006, 2007. So it's actually the oldest investment inside of our portfolio of companies today, but they've done well. We're seeing renewed interest in the oil sands, which has helped out their utilization. We're looking at some investments there that will increase the room rates, that I think will be encouraging for that business, and we've got a good leader there. So to the extent that he finds investment opportunities for us to deploy capital, I think he's certainly shown that he's a good leader and done a very consistent job at generating free cash flow for us.
Is that business currently free cash flow positive?
Yes, that business is currently free cash flow positive. I think, quite candidly, we'll see how some of the segments shake out with the sale of the T&D company, but the accommodations business may be one of them, as we look on a go forward basis, that could end up being split out again as a segment, which would obviously provide a little bit better visibility on that particular investment. But that's been a good investment for us.
And is that business exclusively in Canada? I know Black Diamond, I believe, they sort of pivoted their strategy to do more than just the remote accommodations, but using that as kind of get more in the mobile mini remote, operations.
Yeah, I think there's some opportunities to expand outside of Canada. It flies a little bit under the radar, but our president that leads that entity led the housing effort for the linemen in Puerto Rico. So he chartered a couple of barges that we housed the linemen on during Puerto Rico in, say, October of 17 through about May of 18. So he's certainly got the ability to pivot to other geographies. And there are some investments in the U.S. That could be a potential for him and his group.
And I want to circle back to the infrastructure segment. I know there's more in there in terms of the rentals, the traditional kind of telehandler crane business. I know you have now aircrafts lumped in there too. Can you talk about the outlook you're seeing there and for the rental business you've talked about growing it in the past?
Yeah, so we've seen strong demand on the rental side of the business, which today is largely oil field. I think there's an opportunity for that team to explore expansion into construction. Much of that equipment, cranes, telehandlers, man lifts, is the same in construction as it is in OFS. So, I think there's an opportunity there for them to continue to expand their customer base. But even on the OFS side of the business, they're seeing fairly strong demand so far this year. Most of their assets are in the Utica and Marcellus, but they do have a location and some assets in West Texas as well.
When you look to deploy capital in that segment, what kind of returns are you looking at there?
It's a good question. So as we look at those investments, they're mid to high teen in regards to IRR on an unlevered basis.
And does that vary whether you're buying a small piece of equipment or a big piece of equipment? I know with the rental companies, that was always, it always had higher utilization with the smaller pieces. They wanted to switch from the big dozers to the littler pieces to kind of get a better return.
It does vary a little bit. So we try to look at it on a type of equipment by type of equipment basis, because you make a good point. It does vary. Some of the larger pieces of equipment, cranes, we're seeing fairly high demand on. So that's a unique situation where you've got a larger piece of equipment, but you're seeing fairly consistent demand.
And then you also have a fiber business, I believe, that didn't go with the T&D, and also an engineering kind of professional services business. Can you talk about how you got into those businesses and what the outlook is for those two?
Absolutely. So both of those businesses were started organically. So we identified the leaders of each of those businesses, brought them on board, and then built businesses around them. On the engineering side of the business, they've got about 75 professionals today. So grown that, into a nice size business. That's a business that's human capital, as opposed to assets, but they've built a nice business, and that's a business that, as we look at incubating, should trade for low to mid double digits in regards to EBITDA multiple. The fiber business, took a little bit longer to ramp up than what we had envisioned, and much of that was due to some of the delay of the government funds hitting the states, and then the states apportioning that out. But we're starting to see that hit the market. You know, as with most of the businesses, relative to infrastructure, it's a business about building the backlog and executing. But that's a business that we feel like has a runway of success to grow that business, and potentially do some acquisitions. The fiber business is fairly fragmented. So that's a business that we're interested in.
When I think about your portfolio, now that it's obviously mostly cash, but your operating businesses, it seems like you have on the industrial side, the professional services business, the engineering, the fiber, the rental airplane side and helicopter, kind of the rental crane and telehandler OFS side, accommodations business in Canada. And then you have some legacy oil field businesses in the pumping, the sand, directional drilling. Are those the major buckets? Did I miss any major operating line?
No, those are the major operating lines. We've certainly got some underutilized assets that we've got, coil tubing, drilling rigs that are out there, that we could put back to work. I think as as we continue to evaluate those businesses, we'll see what the demand and appetite is, relative to those that we've had parked for a few years.
And I noticed in the March 31 balance sheet, you had about $5-6 million of assets that are now held for sale. What are those, and what made you put them on, in that part of the balance sheet?
Yeah, so that's a strategic decision to exit the drilling rig business. So that's what you see on held for sale. Those are assets that we are net sellers of. So we'll continue to market those rigs, and seek an exit. But that's the value of those rigs, from a book basis, that we've determined at a management and board level to exit.
Okay, so that's on the book basis. You also did an appraisal last year. You put in your presentation, I think it was $190 million. You had a third party appraisal company come in, and then I think you revised that somewhere to 145 after the sale of the T&D business. Is that right?
That's correct. That's an appraisal we had done to just take a snapshot look at the valuation of the assets. We had that done by Range, which is a group that does a lot of the OFS related appraisals for a number of the lenders.
Did you just send them a sheet and an inventory, or did they go out and like look in the yards and look at everything?
No, I think historically, Range has been very very professional about going out to the field and looking at the equipment, and that's what they did for us. Is they went out and looked at probably 90 to 95% of the equipment as part of that process.
And they provide an appraisal based on, so a lender would lend against it, or do they also provide kind of, monetization services, sort of like a Ritchie Brothers or anything like that?
They don't necessarily provide monetization services regularly. I think that's within their wheelhouse. But what most companies or lenders would look for Range to do would be to put a fair market value or orderly liquidation value on the portfolio, and then I think most of the asset-backed lenders in regards to PP&E are lending somewhere in a zip code of 50 to kind of 60%, depending on the lender, of what that valuation looks like.
Well, you guys have a lot of cash. Help me understand why you would hire them to do this. What inspired you guys to do this?
One, to get an updated snapshot of the asset base that we've got. But also, as we look at where we're at, we're trading at a slight discount to cash, with little to no value placed on the ongoing businesses we've got or the PP&E that we've got inside of the portfolio.
Within that PP&E, how much is for the sand, for like the sand business? Are they giving you credit for like reserves, or is this just literally the dryers?
That would literally just be the dryers and the wash plant. So relatively, I'd say low valuation relative to sand. There's no reserve value placed in that particular valuation at 145.
Okay, so orderly liquidation, kind of steal value. That's helpful way to think about it. And how much could you know, how many assets do you have? What's the value of the assets you have, like drilling rigs, coil, that are not operating? What's the value of that if you had a buyer? If it was a liquid market, how much could you free up? How much cash could you generate from steel with grass growing around it?
There's a fair amount of value inside of the portfolio for assets that are underutilized right now. So we've shown in the past that we can put assets back to work. But certainly, like the drilling rigs, we carve them out as held for sale. That's something that you can place a pretty easy bogey out there at 5 million or thereabouts. Probably a floor of sorts on the value of those drilling rigs with some potential upside.
How liquid is that market if you wanted to monetize them? Is that something you could do kind of monthly, quarterly?
If you look at those auctions, they're usually quarterly or thereabouts. Can be done quickly. Usually has an impact on price. But most of those larger auctions like that, are on a quarterly basis.
So when I take a step back and I think about what could TUSK look like, or where are you trying to grow the business? How are you trying to deploy capital, and where are you trying to grow the business in which areas?
Based on what we're seeing today, we're trying to grow the rentals business. We'll continue to evaluate and might grow the remote accommodations business. If we can firm up, the fiber business, that's another one that has potential. But near term, I'd say material deployment of capital. We've shown, and you're seeing that That's largely in the rental business broadly, whether that's OFS or in the aircraft space.
What is the company's capital allocation process? How do you build the pipeline, and how is Wexford involved?
Wexford has been involved through a consulting agreement that's been in place. We're not paying right now for that agreement, so we get the deal flow through the relationship with Wexford. We discuss those opportunities at the board and management levels, and then deploy capital where we see the best fit for the organization. But certainly the relationship with Wexford and access, particularly to the aviation deals, has been very good. As I mentioned earlier, they've got decades of experience in aviation, so being able to tap into that expertise and deal flow, I think is beneficial for us.
How deep is that market for aviation? How much capital could you deploy there?
We could deploy a tremendous amount of capital in that space. And you're talking about deals that range from, one to, say 10 to 12 million. But if you pick up the cadence with those deals, you can deploy a fair amount of capital fairly quickly.
It sounds like that seems to be what you did in April. It seems to be the most attractive way, and the way you're talking about that seems to be the primary, the returns.
Yeah, that along with some of the other businesses, but near term, those are where we're seeing the most attractive returns for investment.
So you mentioned there is a $500,000 kind of consultant fee from Mammoth to Wexford. You're saying you're not paying that now? They just kind of said, don't worry about it right now?
Yeah, so that's what the contract has, but Wexford has waived that for the last several years. So obviously, right around 47% of the outstanding shares, they have a vested interest, and they're providing us access to that deal flow without the associated $500K fee.
What are the other places like Wexford? They could put the money in Mammoth and buy it through Mammoth. Do they have other vehicles that I know they've got a lot, hedge funds and private equity. How do you compete for capital within Wexford?
Yeah, they've got a lot of other deals, but certainly they have a vested interest in Mammoth. They've, as I mentioned, the oldest entity was formed in 2007, so they've been invested for quite some time. They're not on a fund horizon or fund mandate, so they've clearly been very patient with their investment, which is what they've shown in the past with both Gulf Board as well as Diamondback and others. They've always shown to be very thoughtful, patient investors, and I think that's what we're seeing with TUSK is, they've been patient, and they're very involved in helping us, with the deal flow, which is, as I said, is very important.
I also think there's a share repurchase in place.
That's correct. The board had approved that a couple of years ago, and is part of one of the credit facility amendment that was executed earlier this year, concurrent with the T&D sale. There's the ability to repurchase up to 10 million shares or $50 million, whichever is lesser.
Any activity like a 10b5-1 or any comments you can make about the practicality of, obviously, the stock's below cash, you have all the 145 of appraised value on top of that, but not a lot of float as well. So how do you weigh that as the CFO?
Yeah, so it's, certainly we're restricted, to the extent that we wanted to repurchase shares by the volume. So that there's a restriction in place there on what we could buy. It's certainly a consideration, as you look at the stock, it's below cash value. But given that stock somewhat thinly traded, that's also a consideration for myself as well as the board as to whether or not it's prudent to repurchase shares when you've got limited float.
How does the management team and the board think about rebranding and just communication around the strategy, given where the energy business is, given the big cash pile?
As we look at it, we realize that we've got to identify where we have some sectors that we think will invest this money. We've shown a little bit of that with the April investment in the 8 planes.
Mark, it's I want to say thank you for your time. I've enjoyed speaking with you, catching up on the story the last couple of years and speaking with you over the last 10 plus years. I've always appreciated the candor and kind of being a straight shooter and telling me what markets are good and what, not really spinning things, but just telling me how it is. So I think that just goes a long way in building a relationship over time, and is something I appreciate. So thank you.
Likewise, always appreciate the opportunity to catch up.
All right. Well, thank you, and we'll be in touch over the next quarter or so.
Sounds good. Thanks, Doug.
Thanks, Mark.
Please make sure to follow Pitch to PM on your favorite podcast app and never miss out on episodes. This show is for entertainment purposes only. Please consult a professional before making any decisions. This show is copyrighted by Pitch to PM. Written permission must be granted before rebroadcasting.